Poor housing data drive dollar down by www.forexconspiracyreport.com. The U.S. dollar had been steadily rising against most major foreign currencies. The concern about when the U.S. Federal Reserve will reduce its quantitative easing (QE) program, and by how much, came to the fore. The most recent worry about the QE reduction came as new home sales in the USA fell dramatically. Previously, bond buyers were selling as they expected interest rates to rise even farther. Now, if housing data is telling us that the U.S. economy is not as strong as expected, the Fed may hold off and interest rates may move down again. Thus, as poor housing data drive the dollar down, it is the actions of the U.S. Federal Reserve that the Forex market is watching. The yo-yo effect of Fed watching and market sentiment. Fundamentals are what eventually determine prices of foreign currencies. However, the market attempts to foretell the future. A reduction of home sales in the USA is news that is important to Forex trading. Likewise, pronouncements of the U.S. Federal Reserve are watched by traders. When one piece of news is dependent upon another, there is a yo-yo effect. Expectations of higher U.S. interest rates drive the currency up. Expectations of events that will cause the Fed to drive interest rates down, in turn, drive the currency down. There are two ways for traders to respond to this. One is to use technical analysis of Forex currencies as your guide. Follow pricing curves and use them as a guide to future price changes. This is the way that Japanese candlesticks work. They use the fact that price patterns repeat themselves. When a trader identifies the first part of the pattern, he can reliably predict market sentiment and the next part of the price pattern. He can then trade profitably. The other route is to rely on the fundamentals. Poor housing data drives dollar down. Just how far? As poor housing data drives the dollar down, a fundamentals-based trader asks the question, just how far will this go? Forex currency rates will eventually be determined by fundamentals when the market adjusts. A fundamentals-based trader is patient. He analyzes what factors such as poor housing data will do to the price of yen in U.S. dollars. He also needs to analyze what new economic policy changes in Japan will do to the yen versus the dollar. When he finished his calculations, he will determine a price at which he wishes to buy dollars with yen or yen with U.S. dollars. He looks at the market to see if there is a profit to be made by buying Forex options. In a sense, the fundamentals-based trader waits for the market to come to him, while the technical trader chases profits. Each trader can make a profit. To a large extent, it depends upon closely following the market and shifts in fundamentals. And, as always, do your own fundamental analysis, and remember that no one ever lost money by waiting on the sidelines when things are uncertain. The old quote in trading is that there are no strikes called in trading stocks, commodities, or currencies. For more information and insights about trading foreign currencies, visit www.forexconspiracyreport.com.